Welcome to 2024 Economic Preparation and Depression Channel. I'm your host, Tony. Thank you for joining me. Thank you for joining me on this Sunday edition, September 1st, 2024. It's apparent now that rate cuts are going to be the name of the game heading into September here as we head firmly into the third quarter and leave away from the summertime blues of the euphoria of the Roaring 20s so far. So far, the Fed is predicted to have three rate cuts, quarter point rate cuts of 25 basis points each, according to Routers.com and many others in the financial community. However, even though this remains to be certain, what's uncertain is to what effect these three rate cuts of 25 basis points for a total of 75 basis points by the end of the year, what effect would that have on this economy, or if at all, because did they wait too late to cut rates? So, this is going to be this follows a weaker than expected July jobs report, as you know, that we've been talking about on this channel. And so now investors are scrambling to try to make adjustments to the previous forecast, which had called for more rate cuts sooner. So we have a September meeting, a November meeting, and December meeting, taking us down to about 4.5 to 4.7% by the end of the year. So that's what we're looking at right now in terms of the Federal Reserve meetings. But it's not just a rate cut. What they have to do, what they really have to struggle with, is the unemployment rate, as well as the high prices that many Americans are facing in food, gas, utilities, transportation costs, input costs for kids, and things of those nature. That's going to be the real test of this economy going into next year. Many people feel like next year is going to be really rough, especially once we get past January, February, inauguration, and all that stuff. Towards April, it's going to be really rough. Here from the capital, radiating all the way out to the West Coast, as we continue to see that recession is still there. Now, this article points out that recession is unlikely to be happening because GDP growth is around 2.5% this year, and they had forecasted for only to be 1.8%. However, anything below 3 is still not great for this economy. And consumers power U.S. toward a soft landing. This is according to Bloomberg.com. Many people feel like this economy is heading toward a, quote, soft landing. Many other people feel like this economy is heading toward a hard landing because we're going to have a place where prices are rising, but wages are not rising, and that creates a stagflation environment with no hiring, just like what we had in the 1980s, early in the 1980s. And there was, you couldn't buy a job, and inflation was going up, and interest rates are going up. And so our fear is that the Federal Reserve will make these three cuts this year. Next year, come back and try to cut drastically. But the cuts won't be in effect, and prices keep rising. Then they're going to have to end up raising rates even higher than what they were before. And that's going to create a big problem for the U.S. economy, at least at the home base. So this is what we're looking at here. U.S. consumer spending picks up as inflation trend softens. Yeah, they spend a little more money, obviously, because ending summer, school is back in, all of that nature. But people are still spending less eating out than they had before the health crisis and before everything else that was going on. And then we also have the conflict still going on around the world. That's something to look out too. And also just something interesting too. China's weak factory activity data raises pressure concern for consumer stimulus. So China's having weak manufacturing gains this past 2 or 3 months, and people are calling for more stimulus packages to be made for the local middle class in China. Will we see more of that in the U.S.? More stimulus packages, more helicopter money. Obviously, QE is beginning again with these rate cuts, and who knows how much bad debt the banks are buying up between interlending banks and all that. Who knows what's going on behind the scenes. But we do know is that quantitative easing is certain to come back this year and also into next year. But how much would that help the patient as the dollar is struggling to keep pace here with the other broader economies and currencies and other things of that nature? So the dollar is the strongest currency right now in the world. That's good news. The bad news is that purchasing power is going down significantly. Many people have 2 or 3 jobs, side hustles, a main job, this side hustle, and they're reporting to me that they're struggling to keep pace with this cost that's just gotten not quite hyperinflation where we're seeing like crazy stuff, but we are seeing a concern in the prices now, and I think that's going to be noted in the next economic meetings later on in October and November once we get past all of the election drama. So we have all of this playing out in the world economy. Like I said, continue to stack, continue to prepare, because time is not on our side. And so if you're not moving, you're standing still, and that's a dangerous place to be economically, physically, mentally, spiritually, and emotionally as we go through this marathon of a recession that we're going to be having here. That's going to last at least a minimum of 5 years, possibly 10 years like Japan had, but ours is going to be worse because we're just not going to have the wage growth and the jobs, at least with this automation coming over and technology coming over, replacing jobs, and the new workforce coming over from overseas to replace jobs over here. So that's going to be the problem that we're going to be facing. We're going to be talking about that more later on after the Federal Reserve meeting in about 2 weeks here. So God bless. I'll talk to you very soon. Thank you for listening and have a great Labor Day weekend.